So now I would like to talk a little bit about main capital charges associated with clearing, and they come in form of initial and variation margin. Variation margin we will talk on the next slide. Initial margin. So this is a capital charge calculated at inception of the trade. Usually it's a charge, so you trade, if it's taken by itself, it's of course you have to put more money as initial margin. But because calculation is based on the whole netting set with the central counterpart, in principle, a new trade can lead to decreasing the initial margin. So it can basically, instead of putting more money, you have to put less money. So it is calculated as historical VaR on shifts of underlying market factors. So if you have interest rate swap, you want to calculate the initial margin on this, you have to shift your zero coupon rate according to some historical scenarios. And but many methodologies used by CCP, central counterparties, are still not finalized. And this I will explain basically what's happening in the next part. So in May, LCH SwipeClear changed its formula for interest rate swap. So it used to be that look-back period, historical look-back period was 5 years. Now it's extended to 10 years. So now if you want to calculate historical scenarios, you have to get your data for 10 years. The reason it was done was to include a period of stress in September 2008. Otherwise, if it were just 5 years, margin would suddenly drop in September 2013 because historical period won't include this period of biggest turbulence. Second change which was done, it used to be that out of historical data, they were extracted relative changes of interest rates, but now they were changed to absolute changes. And the reason is that because 5 years ago we had high interest rates, so relative shifts when applied to today's low rates, we are basically understating the risk. While if you apply absolute shifts now, then that will be definitely some big movement. So both these changes, they basically tend to increase margins, initial margins. The third change, actually it's pretty kind of benign change. Worst loss was replaced by expected shortfall. So when you have historical, when you deal with historical VaR, you have to decide basically what percentile or how you define your VaR. Is it 99%? Or so it was worst loss. So before it was taken. So if you have 10-year history, you just taking one worst loss during these 10 years. Now it's replaced with average of 6 worst losses instead of just one worst loss. And this is much more stable metric, and which is recommended for VaR calculations in general, not only for CCPs. Okay, variation margins. Variation margins, and here I also will discuss liquidity issues because they are kind of closely related. Variation margins are just changes in P&L of the netting set with CCP. They're both positive and negative depending on how PV of the trade changes during the life of the trade, or the whole netting set again. And they can be significant depending on market movements. And because of this, because of the fact that CCP will get this collateral, variation margin collateral from counterparts, but then will have to pay back this collateral if market move in another direction. So CCP only accept cash as variation margin. As initial margin, they can accept or usually accept some high-grade, high-quality collateral, but for variation margin, it's only only cash. And as I explained, this variation margins can be significant in time of stressed market conditions. So that's in this time, the need for cash is highest, and unmet margin calls can trigger a liquidity crisis. So basically, you need cash in time when you have to put these margins in time when you need cash the most. So there is a danger that by reducing counterparty risk, CCPs create significant liquidity risk, and that could precipitate the next crash. So this is something which I think industry have to keep in mind. Another issue is risk concentration. According to OCC report published in first quarter of 2013, four largest U.S. banks account for 93% of notional derivatives exposure. So it's really too big to fail, and that's another issue why CCPs can lead to some really concentrated risk.